Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the share, like, and subscribe buttons. Welcome to 2023, our first video of the new year. I hope you had a good New Year's with celebration with your family and friends. Last video, we talked about what are the most likely things that I thought would happen in 2023 with Bible prophecy significance. And number one on that list was a global depression or financial crisis. And today we're going to talk about one of the specific reasons I believe we're going to see that and why it relates to Bible prophecy. But regardless, I think as we go into this year, we're going to see more of the birth pains that Jesus talked about. Things are not going to go back to what people call normal prior to 2020. People say, well, when are things going to get back to normal? They're never going to get back to that time. We're going to continue to see these massive global events taking place. And I believe the most likely event we're going to see in 2023, doesn't mean it has to be the only one, is going to be a global depression or financial crisis. And to explain one of the reasons why, I think it's coming very soon, probably in as soon as a few weeks, but I've been wrong before, certainly. I don't think I'm wrong about it happening, but I could be wrong about the timing. But we're going to look at a chart, a couple of charts actually, that I think will sum this up and visualize it for you perfectly, that what is coming, that there's something very terrible coming economically to the world in 2023. So I want to start with this. This is from the Federal Reserve Bank. This is their statistics from the St. Louis branch of the Federal Reserve. And what we're looking at here, this is a chart of the federal funds effective rate. As you can see, data goes back to 1954. We see it's got ups and downs, peaks, valleys. It's all over the place. So what is this? First, let's talk about what is this federal funds effective rate. They define it here. It says the federal funds rate is the interest rate at which depository institutions trade federal funds, meaning balances held at Federal Reserve banks. So these major banks like J.P. Morgan and Citigroup and Wells Fargo, they all have accounts with the Federal Reserve banks. And that's their lender of last resort, as established really prior to the Great Depression, but since then people have said that the Federal Reserve should be there to help provide liquidity to banks in the event of bank runs or some sort of economic turmoil. So we see here it says, which depository institutions trade federal funds with each other overnight. When a depository institution has surplus balances in its reserve account, it lends to other banks in need of larger balances. In simpler terms, a bank with excess cash which is often referred to as liquidity, will lend to another bank that needs to quickly raise liquidity. The rate that the borrowing institution pays to the lending institution is determined between the two banks. The weighted average rate for all these types of negotiations is called the effective federal funds rate, and that's what we're looking at. The effective federal funds rate is essentially determined by the market, but is influenced by the Federal Reserve through open market operations to reach the federal funds rate target. So what in the world does all that mean? Well, it means when you hear in the news that the Federal Reserve is raising interest rates, they're talking about that target Fed funds rate, which is what directly influences this rate. So it means if J.P. Morgan has an extra $1 billion and Wells Fargo needs an extra $1 billion to balance their books at the end of the day, J.P. Morgan lends that to Wells Fargo, and right now they're charging a rate of 3.78%. So we see, again, this rate that they charge each other has gone up and down over the years. The lows were post-financial crisis, 08, 09, you had lows that were pretty close to zero. I mean, 0.09, in 2014, but you had highs back in 1981 when they were fighting to push off inflation, and Paul Volcker and the Federal Reserve were raising interest rates, that Fed funds rate. It got up as high as 19%. So you've seen it all over the place. So people would look at this and say, well, right now it's at 3.78. You know, that's higher than the near zero it was in 2021, but it's nowhere near the all-time highs. It's still probably below the average over the last 60 years. So what's the big deal? Why is everyone talking about they're raising rates and it's going to cause a massive recession or even a depression? It's going to cause the financial markets to collapse, bubbles to burst. Why is everyone saying that? Well, if we take a look at the same chart, but we look at it in a different way, we get the answer. We see it vividly illustrated. So we're going to look at this chart, but instead of looking at the Fed funds rate itself, or this Fed funds effective rate, we're going to look at it in percentage terms, year over year change in percentage terms. And when we do that, we get this chart right here. Now, if you notice, this also goes back to 1955. And so our highest all time prior to this year was a 410% increase year over year in July of 1959. So we have decades of data here that show this bobbing up and down various rates. And now we get to 2022, March 2022, 185%, 371%, 1,412% in June. All the way up to, this data goes to November 1st, 2022, where we're sitting at a 4,625% year-over-year increase in the effective federal, or the federal funds effective rate. Now, keep in mind, so this data, and this is supplied, this is the official government data, it only goes to November 1st. So they have yet to release data for the rest of November and December 2022. Well, on November 2nd, the Federal Reserve changed their Fed funds target rate. They increased it 75 basis points, or 0.75%. And then on December 14th, they raised it again, another half a percentage point. So if we incorporate that data in, this line goes all the way up somewhere around here over 6,000%. This is absolutely unprecedented. I mean, look at this. This is data that goes back decades. And this is what's happening right now. So when we talk about why the Federal Reserve raising rates has such an impact, when we look at it in this context, we can see how they are going to break something, because it's not that the federal funds rate or interest rates reach a certain place, because they've been higher before, but it's the rapid pace of change that makes the difference. You know, we saw in Europe where energy prices went up triple, quadruple what they had been a year before. Well, a tripling or quadrupling of energy prices isn't a big deal over the course of 30 or 40 years, but in the course of 1 year, it makes a big difference. It makes the difference between businesses being able to continue to operate and having to shut down. And the same is true here when we're looking at interest rates. When you go from mortgage rates below 3% on 30-year mortgage rates to over 7% in less than a year, that has catastrophic consequences for people's ability to borrow and pay current market prices for housing. That has huge consequences for people's ability to purchase new vehicles, do home renovations, whatever they may need to borrow money for. And if they aren't borrowing that money, then it's not getting paid to the people who are creating those cars, building those houses, doing those home renovations. And so it effectively breaks the economy. So this is This is exactly what I had in mind when I talked about we were heading toward a Lehman Brothers moment. So the collapse of a systemically important financial institution like we saw in 2008 that led to credit market problems all over the world, led to a stock market crash, led to a severe recession, high unemployment. And I thought back in August, I thought, well, by November 1st, we're going to have something similar to that. And the reason I thought that was precisely because of this. You cannot raise rates this quickly, this rapidly. You can't have this rapid change and not have something break. People didn't plan for this. Businesses didn't plan for this. These haven't had time to set in before they're going up even further and going up even further. And it's going to break something. And we're going to see, I believe, that Lehman Brothers moment. Again, I was wrong on the timing before. I may be wrong on the timing now. I believe this could happen in a matter of weeks. We may be standing here a year from now, looking at this weight even higher and saying it hasn't happened yet. But I don't think so. I think this is coming in 2023. They've pushed it too far. The market is going to break. We're going to see the bubble in stocks, bubble in bonds, bubble in real estate collapse. We've already seen those bubbles burst. The highs have been hit. But I believe there's much further downside for prices in real estate, prices in bonds, prices in stocks. And that's going to have an enormous effect on economic activity, people's willingness to go out and spend, people's willingness to borrow. These higher interest rates definitely have an impact on people's willingness to borrow. And so we are heading toward another financial crisis, I believe much worse than what we saw in 2008, 2009. As I said in the last video, I think it's going to be as bad as severe as the Great Depression of the 1930s. However, it will not be as long in duration. We're not looking at a decade-long downturn. We're looking at 12 months, 18 months, maybe 2 years at best. But the reaction, the government reaction to this is going to be to turn on the printing press and hand out currency to everybody who will take it in order to avoid that deflationary spiral we saw in the 1930s. And the result is ultimately going to be hyperinflation, I believe, in the end. But first, we're heading toward this severe crisis. Now, if there's any doubt about that, I want to look at this tweet from Hedgeye, and it just says, guys, and here, this is a chart of the lender of last resort has begun lending U.S. Fed primary credit. So what does that mean? That means when the banks won't lend to each other, as we were talking about before, JP Morgan has excess cash, Wells Fargo needs some, they lend it to Wells Fargo. What happens when they don't trust Wells Fargo to be able to pay them back? They say, we're not going to lend to you. So what does Wells Fargo do? Well, they go directly to the Federal Reserve. And that's what we see here is let's enlarge this chart and look at this. So this is what we saw in 2008, 2009. We saw more and more banks and financial institutions turning to the Federal Reserve for that credit because they couldn't get it in the free market. Institutions did not trust each other. They were afraid. They were fearful of lending to each other for fear that it wouldn't be paid back and that it would create essentially a domino effect of bankruptcies throughout the system. So then we saw no problem at all after they resolved that liquidity crisis until we got to the unpleasant events of early 2020. I don't even know what I can say on big tech now in regard to that, but we all know what happened in early 2020, and there was panic in the markets. The stock markets collapsed, liquidity dried up, people turned to the Fed, but the Fed quickly, cut rates down to zero, started buying up every mortgage-backed security they could get their hands on, junk bonds, corporate bonds, whatever they could get their hands on. and brought that under control. But now we're starting to see this head up, similar to what we saw here. And it's only a matter of time, I believe, before it shoots straight up from a panic moment such as the collapse of a bank like Lehman Brothers, similar to a major market event like we saw in early 2020. And when that happens, I think they've pushed it too far this time, because what happened back here, we had a low inflation environment, so they could turn on that printing press. Here we had a low inflation environment, they could turn on that printing press. The whole stated reason they've been raising rates is to head off inflation, keep inflation at bay. So how did they then turn around, do a complete 180, lower rates to zero, flood the world with dollars, and not end up having major inflation? And I think that's what's going to happen. They're going to take this too far, trying to show that they mean business. They're really going to put inflation under control, and they're going to break the credit markets. And they're not going to be able to fix them overnight. And it's going to cause major problems, and then they're going to overcorrect on the other side, print too much currency, and cause hyperinflation. So, guys, this is how it's going to happen. This is how this financial crisis, this global depression, is going to come upon the world. We're seeing the beginning sequence of this right now. So what does all this mean? What does this have to do with Bible prophecy? Well, if we look at history and we see these times of economic turmoil and chaos, like the French Revolution or the Weimar Germany hyperinflation and the Great Depression, those lead to the rise of demagogues like Napoleon and Hitler. We're going to see similar things happen, because this isn't all that's going on in the economic background. We went over some other things in the last video. What about, we've seen the same huge surge in energy prices in Europe, and what that does to, collectively, the world's largest economy is the Eurozone. And so when we see this on a global scale, it's just going to be massive. And so this is going to turn out the politicians who will promise people whatever they want to hear. If you just put me in power, I will fix it. And we know that they have central bank digital currency ready and waiting for a crisis to roll it out. And so what did I say they're going to do? They're going to roll out that free cash to try to avoid that deflationary spiral we saw in the 1930s. How are they best going to do that? Well, come claim your central bank digital currency wallet. There's cash there waiting for you. There's $10,000, $20,000, $50,000. And in the midst of economic turmoil, job loss, unaffordable grocery bills, utility bills, people will gladly take them up on that offer. And when they walk into that cage, the government will shut the door behind them. So guys, this is all leading to, I believe, ultimately the rise of, setting the stage for the rise of the Antichrist and the mark of the beast system. We're seeing it take place, and I believe this very well may be the crisis, or the beginning crisis, that helps set the stage for all of it. So we'll keep an eye on this. I'll keep you updated as the year goes along. We'll look at this chart when next time they update it, because I believe it's really going to, well, not this chart, but this chart right here. Well, not that chart either. This chart right here, when they update it, we will take a new look at it. But I think this line's going to go straight up. And then once they do that pivot out of fear, it's going to come straight back down. And we're heading toward, full on board toward a great financial crisis. Far worse than 08, 09. Because again, it's not the change itself, but the rapid pace of change. I mean, imagine if you run your car into a brick wall. That's a sudden stop. It's a rapid change. Well, at 5 miles per hour, not as big of a deal as it is at 55 miles per hour. That's what we're going to see here. So it's this rapid change from 55 to 0. And that breaks things, guys. It breaks things, and we're going to see it break the credit markets. So, no doubt in my mind, there is a major financial crisis coming. I believe in the year ahead, maybe in a matter of weeks, we could see that Lehman Brothers moment. I don't know, but we'll stay tuned. And as soon as something happens, I will let you know about it. But in the meantime, let me know what you think. Leave your comments below. I mean, do you think this is normal right here? I mean, decades and decades of history tells us this is extremely abnormal. But let me know what you think below. Make sure to like and share this. God willing, I'll see you tomorrow. Bye. If you want to learn more about the end times and Bible prophecy, make sure to sign up for my free monthly newsletter and get your copy of my free ebook, 7 Signs of the End Times. Just follow the link in the description to get your free book. Also, make sure to check out all of my books. Just look up Britt on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.